and welcome. You're watching Business Today TV. I'm Sakshi Batra, and this is where we discuss the hottest news of the day, the merger of PVR and INOX, and what this really means for investors, for both these companies, and for the exhibition industry at large. To decode the merger math with me today, joining right in is a very special guest, Mr. Avinash Gorakshakar, Director Research at ProfitMart. Thank you so much, sir, for taking out time for this discussion. First up, what do you really make of this PVR INOX merger plan, and what does it mean for both these companies in terms of synergies going forward?
Sakshi, I think this is one of the biggest mergers announced in the multiplex exhibition industry. And I think what is going to happen is that in the multiplex ecosystem, we are going to find a company which is going to be significantly large. It will enjoy significant amount of pricing power with the producers. And I think this is a change of times, considering that OTT business has been eating into the revenues of most of the exhibition players. So I think net it's going to be a big opportunity with roughly about 1,500 screens on a total consolidated basis. I would believe that shareholders could expect a lot of value upside over the next 1 to 2 years once the benefits of this consolidation and merger actually play out on the numbers.
Exactly. And that's what I wanted to understand from you, that how will the shareholders really benefit? We know that both the stocks also hit a 52-week high today. So how do you see the stock movement going forward? Are you positive on both of them or one over the other? And what targets do you see for these companies?
I think clearly, as of now, looking at the, share swap details, like, every INOX shareholder is going to get 3 PVR shares for every 10 shares they hold. So obviously the mechanics is very clearly, largely now more in favor of INOX because, the price has not moved up significantly like what PVR has moved up. But clearly, in the near term, INOX could see better, at least till the time the merger does not culminate finally. And we could see levels of even 650, 700, in fact, before the merger is finally sealed and, finalized. More importantly, once the both the entities are listed, on an independent basis, Sakshi, you could possibly find that the levels could be significantly high. We believe that the combined top line of this company could be about 6.5 to 7,000 crores, and obviously the bottom line could be in excess of about 600 to 650 crores. So I think there could be a lot of synergies. There could be a lot of cost cutting benefits which would come in, because obviously when both these units merge, there would be a lot of costs which could be duplicated and that could be minimized. Yes. So I think markets would obviously look at these margin expansion kind of possibilities. And plus, once the deal is finalized, it becomes an independent entity. I think the market would also like to hear the commentary from the, from the company management. With COVID now out of the way, normalcy coming up and a lot of movies lined up in FY 22-23. I would believe that it would take a couple of quarters for the markets to understand this, because consolidated numbers would be coming. As of now, investors would look at both these companies independently and club the numbers. But once the numbers come on a consolidated basis for both the companies, I think that point, you could see a lot of upside, considering that this is a very growing industry, and I think people love to go out. And this is one fact which is been not happened in the last 2 years. So I think you're going to see a lot of latent demand coming in. So I think net, one cannot properly comment on the financials as of now. But yes, tailwinds definitely appear to be positive.
Okay, so INOX, you're saying about 650 to 700 rupees per share also you see as the target. What about PVR, sir?
Yeah, I think PVR stock has already jumped quite significantly. And I think even during the COVID times, this was one share which did not correct significantly. So our sense is that, PVR as a stock definitely would do well. But I think now PVR would have to be seen in the perspective of the merged entity, because clearly, both the promoter groups will have an equal share in the business. And not only the financial share, but even the management acumen will be available for the combined entity. So I think, investors should hold on. I think, as of now, the valuation looks in favor of INOX, but going forward, it's going to be one company. So my sense is PVR shareholders would also benefit. But yes, in the near term, yes, valuations look to be slightly pricey as compared to INOX.
Okay. And sir, like you pointed out very, very clearly, so far we've seen that the Indian multiplex industry per se has largely been a four-player market, pre-pandemic, PVR, INOX, Carnival, even Cinepolis. Now with PVR and INOX, both the bigger entities coming together, they will actually have a 50% share of the total multiplex screens, which is about 3,200. And these combined will have over 1,500 screens now. Will there be a clear monopoly of sorts? And how do you really see their pricing power, bargaining power really changing going forward from here and working for them now?
Yeah, I think definitely pricing power will be significantly better because obviously when a large combined entity would obviously negotiate with film producers, they would obviously get a better markup. But I think the
Yeah.
bigger opportunity is in the growth opportunity. A country like China has got more than 70,000 screens. A
Yeah.
country like India has got 9,000 screens. So you can actually understand what is the growth opportunity over the next, say, 5 to 10 years. And Indians love
Yeah.
entertainment. Indians love going out. So I think you're going to see a lot of volume expansion. And plus, both the companies had earlier also lined up very aggressive plans of putting up new screens in the next couple of years. So I think apart from the pricing power, it's going to be the geographical reach, which I think still is quite underpenetrated in a country like India.
Right. I also wanted to ask you this from the customer's perspective as well. Those who go out and consume movies, we've seen so far as the ticket prices or spend per head is concerned, INOX is at a discount versus that of PVR. Do you see now INOX also going toward more rapid premiumization in line with PVR going forward, and therefore the prices of food and beverage as well, more monopoly over there too? So for the customers, it is going to be more expensive to go out and to get themselves entertained.
See, I think this is definitely going to happen considering the fact that it would be a combined entity. But I think the managements of both the companies have said that going forward, both the multiplexes will be branded as INOX PVR. So
Yeah.
clearly, the strategy would be uniform for all the multiplexes going ahead. Although branding would remain independent. So my sense is that yes, ticket prices could go up, but I think a bigger focus would also be on the F&B part of the business, which is also a significant contributor to the profitability. So I think, yes, ticket prices could also go up, obviously with better pricing power. And I think, moviegoers or investors would not mind paying a high ticket price for a good quality movie. So I think
Yeah.
that obviously is going to be a part and parcel of the business going forward.
Oh, absolutely. And we are already seeing that happen with movies like RRR also hitting the screens. We are seeing prices of almost 2,100 rupees per ticket as well in many cases. So I'm sure this is on the way higher and definitely more expensive for all the people who are movie buffs and who want to go out there. But like you said, so on the valuation front as well, now the merged entity currently has around 17,400 odd crore rupees of the valuation currently. How do you see the market value really getting re-rated going forward from here?
Yeah, I think my guess is that over the next, say, 2 to 3 years, the right way to value this business is not on a net earnings basis, but on a EV to EBITDA multiple basis. And I think the deal has been, cracked at around 9 to 10 times. I would believe, for companies like PVR INOX, which are in a growth market and which have got a very strong consumer market share, could easily get a EV to EBITDA multiple of 14, 15 times. So I think, considering the monopoly they enjoy in the market and considering the kind of geographical reach both of them enjoy, I would not be surprised that, with supply more or less constrained, these players would obviously enjoy a premium, kind of in the markets over and above the normal P multiples. So to that extent, yes, I think a EV to multiple of 13, 14 times looks reasonable. And that is what the market should also look at over the next, say, 2 to 3 years.
Okay. And lastly, sir, if you could help all our viewers also explain to them what could be the risks that one should be aware of or the challenges still ahead, even of this mammoth behemoth multiplex industry that they're going to be in right now, so that when they go ahead to invest, they should also be aware of the risks that exist.
I think the bigger risk is basically on the execution, Sakshi. I think the merger has been decided, finalized, but I think on ground execution is going to be one critical variable which is going to be watched very carefully. As the execution, gets kick-started, I think the market would obviously like to know on a combined basis what is the performance. As far as the profitability of the company is concerned, that is also one factor which most of the analysts and the investors would look at closely, because now both these companies would be looked upon on a consolidated level. So, I mean, what is the kind of timeline and what is the kind of improvement which comes over the next 12 months is going to be critically watched. And these would be the risk factors. Any letdown or delay on both these factors could obviously lead to some disappointment, going forward.
Okay, understood that. Well, thank you so much, Mr. Gorakshakar, for explaining to us what this mega deal really means for investors and for the industry at large as well. Thank you so much for speaking to us and sharing these insights.